things is that, which is why you're so successful, and I keep listening to you and want and aspire to be more like what you're doing, because I'm doing the exact opposite. So I'm not doing anything wrong with calling the trades. I know what I'm doing, but I keep thinking like I'm treating it like gambling, I think, and I'm losing money.
Well, let's talk about that. We need to talk about the psyche of the trader, because I was actually just on a call and there was a lot of people, you know, eager to learn. They got all these questions, but the questions were extremely basic. Now, this class in particular was about options. When you're trading options, the number one thing is if you trade options every day, you truly are gambling. You're not even trading. Because essentially, like I said, when you're trading options and in moments like this, they're going sideways. They're actually losing money in moments like this. Nobody's really making money unless you say you came in and bought a put right here and then you sold it right when it hit here, right? Like if you're coming in on these days and you're making money on the day, but you cannot hold these trades. These are not trades that you can come in and do every day, because on a day like this, we had no movement, right? This is almost pigs to slaughter for options. Okay. So when you're trading options, just make sure you do know that there's increased volatility. So therefore, you don't want to always hold an option, because essentially what people have to understand is that options do expire worthless, right? So in the case of your put, what was the expiration date that you had on it? Do you remember?
Okay, yeah, it was Friday.
Oh, that's why you lost money. That's what I was asking. I was like, hey, was your expiration this week? So the thing about that is, right, you bought let's go take a look at it. So for AMC, number one, I'm buying puts on things that I understand that are feasible. So number one, let's look back at what it had done in the past. We do have this line here at 33. But let's look back, because I feel like there was a time that it jumped up. Okay, yeah, it jumped up back here, but it still only went as far as 33. So let's drop it back down to the day here. So on this particular day is the day that we had that drop where it came back to the 30s and then shot its way back up, right? I mean,
that's the day. Was that Thursday? That was Thursday.
This was Thursday.
First of all, I had no business buying seriously, like from all the stuff I learned. Like, why am I buying a put? No, but I mean, I get what you're saying because you did, but it's like I know what I'm doing, but then, well, sis, you really don't, because like I knew buying the put on Thursday, it was gonna expire Friday. So what was I waiting for to go up? Like I was already up 400%. Like that's the part that I'm having problems with, and I'm losing money that way. And it is psychological. It's certainly not, I know what I'm doing, but I'm greedy.
Let me show you this real quick before I forget it. I'm gonna show y'all. I don't know if the expirations are gone for the 4th yet. Yeah, they are. So for this particular stock, I bought the 580 call on Tesla, mainly based off of the fact that the put call ratio was extremely high for that week. Let's actually look at bar chart to see if it's still listed there.
It was high. I noticed that.
Yeah, so I would have posted it, but it's like, I don't know. I just have a lot of stuff on my plate. And then I'm like, dang, if I would have posted that, other people could have understood why I did this. But for Tesla, let's see, can you all see this on my screen? Let me make it small. Okay, let me make that smaller. Okay, so this Tesla right here was extremely high. Okay, now when you click on Tesla, this is how you really dissect what you want to trade. You can also come to the put call ratio section, right? So you want to go on to the options. Once you're in a stock, right, when we see it on that most active list, I can then click on it and get all this information, right? I can get bar charts, opinion, 72% sale. You know, I don't really, take heed to any of this stuff. Obviously, Tesla is falling. So, I mean, you can come in and take heed to this, but it will come in and tell you these indicator type information, right? Like I said, these are the 50, 100, and then you got the 200 for long term. So when I talk about, you know, the EMAs and the MAs and all of that stuff, like your Bollinger Bands has the 20-day moving average, the 200 EMA or the 200 moving average in general. If you come here, that's long-term, you're going too far, right? So
right.
taking a look at this, number one, I got the alert. Okay. So my alerts right here are set. Okay. I already know when Tesla falling. I don't have to watch it. Okay. So when Tesla comes below 600, I've got a warning. Okay. You keep falling. Now you're in my zone. Okay. So it's 550 and 560. If these hit, I'm going all in. I don't even care what the market does. I don't care what the rest of the market does. I just know at this price, this is where I feel comfortable. Okay. So, and I wouldn't go jotting down these numbers. These are numbers that I trade at. Sometimes it falls below that, right? I got alerted for 555 and 560. On this day, it went to 546. You buy an option here, you really losing some money when it drops. Now, always with options, you all, I am putting stop losses on these. Now, you won't be able to, let's see, I don't know if you can actually order on, nah, it won't let me. I want to make sure that when that bid and that ask pop up, that I'm actually going more for the bid side, right? Because that is my lower price. Okay. Now, if you ask for an ask, if you put in the ask, and let me break this down too, because today I want to talk about options and really dissect these. So when you're talking about the ask is the price that the market is asking for. Okay. So as a buyer, or as a seller of the option that I'm currently holding, I'm asking you to pay a premium of $77 per. Now that's extremely high because we're extremely in the money. Okay. But let's get realistic. Usually when you're looking at trading options, you want to be around the actual price of the stock, right? Because like buying here, you know, yeah, you're in the money, but like how far can it run up is the real question that you have to ask yourself. All right. So when you're looking at the ask here, the ask is going to be the higher of the two prices because it's the seller's ask price. Okay. So the bid is what I'm willing to bid for getting this contract. Okay. So now when I put in a stop loss, okay, for an option, it is not going to allow me, let's say, you know, I bought it at a $13 premium. So I paid $1,385 for one of these premiums that then shot in the money. So let's assume that this 597 was here and now it moved here. So it used to be a $13 premium. Now it is a $16 premium. So right now you are at a $300 profit because of the price move that happened on that particular day, right? So because of this move, these are profiting. Some of these actually started as low as down here because I think Tesla started the day opened at 579. So all of these people right here, right, were technically this price at the market open, right? They were more in this range. Okay. So let's say hypothetically you bought at open at 579, you came in and you bought the 580, which I did, right? Because I didn't buy the 577 because it was already in the money. Okay. The market opened up at 579. Okay. So this was already in the money. I immediately bought the next contract. So you all seeing where and why I bought the 580 when I bought the 580 is because I'm not trying to get cheap. Okay. I don't trade cheap anymore. I mean, like, you know, you can do that. Let's say the money isn't in your account and you want to trade Tesla. If you start reaching for these types of contracts when they're cheaper, just know that while you do stand the opportunity to make some money, you also have a chance to be completely worthless. Okay. So these are cheap because the probability is not there yet. But as you can see, the volume increases, right? So if you're going to go after contracts like these, okay, make sure that you're going to find the one with the higher volume. Okay. Because go ahead.
No, I'm sorry. When you're done, I'll ask a question. It's based on this but finish.
Okay. Well, no, I want to know your question because I don't want to like, go ahead.
I'm sorry. I don't mean to be rude when I get so excited.
No, that's perfect. I want you all to like ask questions. I want you to learn. So definitely.
So I don't, first of all, I do buy cheap contracts.
Do it.
But no, but here's the thing. I think that's some of my problem too, because I know the stock is going to move, and I have been doing more of what you're doing, and I wait when they're at the bottom, and I have my alarm set, and every single, and I follow all of them. So I have my alarm set where it's down there, and I know it's going to shoot back up, like, and everyone I follow, it did exactly what I knew it was going to do. I didn't buy the contract on maybe that one, but so I know I'm in the right direction. But even buying the contracts, I don't ever go. I don't, like, you bought the 580 contract. It's already in the money. You're already going to make money unless it gets
Correct.
crazy and drops, which the odds are not, right?
Correct.
So what I'm thinking now is, okay, but with the daggone money that I lost, I could have bought a more expensive contract. And so I think my problem is I'm buying way too out of the money.
Correct.
And so eventually that mofo gets there, but not in the amount of time that I have the contract. So I think that's some of my problem, right? Because I'm buying, I never buy close to the money.
Now, there are some that, now that's just my strategy, right? I've been there, done that with all of these, okay? I'm tired of this. I don't want to sit and wait to make sure that Tesla is going to get to 615.
Yeah.
Right? Like, and then let's say I want it even cheaper. Maybe I don't have $1,000 in my account, and I'm like, dang, I got 700. I'm willing to put it on Tesla. Like, yeah, you can come buy this, and yeah, there's volume here, but Tesla has to get to this in order for you to be comfortable. Okay, but that doesn't mean that Tesla has to get here to make money. Okay, but that does mean that if Tesla does not make it here and it goes sideways or even turns a penny around, a penny, okay, you are going to instantly start losing money here. Okay,
yeah.
So even look at the gains, though. All of these have reasonably the same gains. Obviously, the lower you get down here, the less your gain is. Okay, so know that too, because like, you're not going to be able to make as much money on these lower ones just based on they're not there yet. And the probability of them being there is decreasing their value just simply because it's not there yet. Okay. So up here, we still have the same amount of actually return, even with people that have made money. But with me buying right here, I guarantee that this stock moves beyond me and I'm only making money from this point. Okay. But when you buy down here, you need time.
You need time, and then you start hoping.
Now, and with that time, know that time works against you. Okay. Especially on these weeklies. All right. So when you look at when you see a W, all right, these are weeklies. Okay. Weekly contracts. These expire extremely fast. Not even all brokerages and stocks have weeklies. Okay, weeklies are mainly for things that are traded a lot. So if you go look at Digital Turbine, is something that I used to trade as a stock. Well, it's got weeklies now. It used to not have weeklies. I'm trying to.
So on Thinkorswim, some of them don't have weeklies. They just have like months. Like if you look on a Thinkorswim, a lot of the June 18th, they're not weeklies. Like, in other words, there's no W weekly.
Yeah.
So I've been trying to figure out, what does that mean? Does that mean that I can hold on to the contract longer, or does it mean whatever?
All these expirations is giving you is time. Okay, so let's take a look and see what July did. Okay, notice that these move at a smaller pace. Tesla has gone beyond these prices, or at least moved beyond where they were. But even then, people only made 27%. Okay. People that bought a week later, they made as much as 40%. If they got really in here, they made as much as 80%. And also notice too, you'll actually lose money on these higher in the money. The longer you hold it, the more invaluable it becomes. Now, you will increase in value, but the value in change, right? The percentage of change that you'll be making will decrease, because the likelihood that anybody even wants this strike price or even wants to pay this much when they can just come here or maybe even just go buy the stock, right? So I don't know what it's like to hold an option so deep in the money, because I'm usually just taking profit. Like when I'm making money, y'all, I'm immediately jumping in. Like when I bought that Tesla call on Friday, like I said, we opened the market up at 579. Okay, so the 577 was right here. Okay, so technically when the market opened, the 577 was right here and the 580 was right here. So that's why I bought the 580, because it was accessible. I could see it right here. And let's see what it, okay, so even in this range, you can tell why people even jump to this 580. Now, it was only such a low volume, mainly because by the time we got into this 2,000 people got in. At this point, you were forced to buy these because it moved so quick. You know what I'm saying? So then maybe you went and got the 590 because it was a little cheaper, you know. So when you look at the strike price, so 1, 2, 3, 4, 5 strike prices away. Okay, so 1, 2, 3, 4, 5. So basically these people, and look at the volume even then, right? And it doesn't have anything to do with a count or anything. It's just like these round numbers that people look for. But you do want to pay attention to the volume, because if there's no volume in it, I don't want to be trading it, right? Because what that lets me know is that there's not going to be that many people available to sell to. Okay, so if there's a lower volume, let's say for instance like this, right? You only have so many people that are willing to buy this after you've purchased it. Okay, but with a 5,000 volume or this 5,000, I have more chances. I mean, 26,000 just because it's right at the money, right? So the reason why I jumped in on that 580, because it was right at the money, and I knew that Tesla, based on this, right? So on Thursday, okay, we closed with our let me drop this down so it'll be a little clearer. But notice here, we closed with this going down with the opportunity to come back up, as well as this was close to down with the opportunity to come back up, right? And I noticed that this orange line wasn't preparing to curl down. Usually it would make a sharp turn towards it. But the most important thing that gave this away is that I came in, number one, you go here, you go to bar chart. I already have it set on most active. So when you go to bar chart, it's actually going to drop you on the home screen. So when you're on this home screen, it's going to give you all the information of bar chart, but we want to go to options. So you click on options, you want to go to most active options. This is what I look at after market close and before the market opens. Really, you can look at it during the day as well. It changes and stuff. Like if you're trading, let's say you come in and you trade sundial, because and even last week we talked about weed stocks, right? We talked about how the put call ratio was low on the weed stocks, right? All of them were technically in the teens as of last week, and you can see what happened with weed this week, with all of them really running up in price, especially sundial. Last week when we talked, sundial was just about 70 cents. Let's see, or was it? Yeah, because last week was actually around this date. Let's see, 6-1. Yeah. So it was in this like 70 to 80 range in here. And then without that, with a low put call ratio, that means not a lot of people are betting against it, right? So for that time, it was able to go ahead and run up with no real breaks. I mean, for this day, it literally jumped up 14%. So we closed at $1.12, opened the next day at $1.29, right? So with these types of movements, it helps to come in and really do your research in the put call ratios, okay? Because these are going to let us know how much leverage is against us, okay? It's breaking down, literally saying, like for Tesla, for instance, it had a high put call ratio. Now, just because it has a high put call ratio does not mean that it's just going to catapult itself up. Okay, that still means that a lot of leverage is betting against you. Okay, now how did I know it was going to catapult on Friday? Well, I clicked on Tesla and I said, well, I want to dissect that particular put call ratio. Okay, and how to do so? You click on the stock, it'll open up its own little, stock page, but then go under options and click the put call ratio right here. Okay, now when I do this, it still has it. Yes. Okay, so this is exactly what I saw, people. Okay. Now I want you all to just really allow this image to burn in your head, because I got so excited when I saw this line here. Okay. So for June 4th, there were more puts than there were calls. Okay. Now, that's just volume. So that's the number one thing I saw. I saw that in general, more people were betting in 1 week against Tesla than they were putting calls on it. Okay, so that's number one. But that's not going to tell you much, because volume can just mean there was that much volume. But how many? Like I said, open interest is what's the most important number for us, because volume is what's happening now, but open interest is how many people are going to hold that thought. Okay. Now look at this. 267,000 open put contracts, okay, with an expiration of June 4th. They have to sell, or they go worthless, or they have to exercise the contract and buy the shares, okay? So if I have 50,000 more contracts of puts on an expiration of the 4th, they have to sell. These people have to sell. Now, these people, they can make some money because they'll wait. They know the stock has been like when you look at big picture, right? Stocks go up. Okay. So big picture, if I'm holding a call into Friday, I'm not scared. What are you going to do? What are you going to do? Look at this. Let's go look at Tesla. What are you going to do? Drag me down further than this? I mean, more people are just going to buy, right? Look at where we are. We are on the 200 EMA. Okay, folks, that's why I told y'all, I don't trade stocks unless we hear. Okay, so when you look at where the RSI was, where the stochastic was already, the momentum was ready to turn back up, right? Notice the price. This price is the orange line. Notice how the momentum left it, saying that I'm ready to sling you back up if you like, right? Because if the momentum was still up here, or the momentum was like right here with the price, I'd be a little more hesitant, right? Because you can see when the momentum doesn't leave the price, then you still got some down to do, right? Because we still in a trajectory together. But when this momentum leaves the price, that lets me know that the momentum is ready to sling back. So I don't care what happens from here. I know that this momentum is closer to this bottom than this price. So now, not all, like when I looked at MACD, it still had the opportunity. If you look right here, it still had the opportunity to cross down. Okay. So I was a little weary on the MACD, but like I said, we're not using one indicator. We need to see 3, 4 types of indicators for confirmation. Okay. So number one, the confirmation was in my 200 EMA. All right, we're here. I don't care what happens from here. I'm willing to take some risk, because I at least know that if we fall from here, I know where we can fall, right? So number one, this candle lets me know that the low was 546. But on this particular day, we closed at 563. Okay. So Bollinger Bands is telling me 551 as a range. Okay. So in terms of when I saw this Thursday, and I opened this up on Friday morning, I think it was Thursday night I saw it. And Friday morning, I got a little more confirmation just based on the how we were opening. Also, if you all you can turn on and off your extended hours. They do affect your indicators. Okay, so when you turn on extended hours, you get different readings, but because you're including price that, like, either went extreme. Some places like Apple and Microsoft, or some things that are heavily traded, even like an AMC, sometimes in the aftermarket, these hedge funds will start like basically buying and selling high and low to mess up your indicators. Okay. So I used to see this happen, and I remember a guy I was learning from told me that I needed to turn off my extended hours. And he was like, that way it won't mess up like your indicators. Because including this price is actually what messes up algorithms, indicators, all kinds of stuff. So when you're trying to chart, and when you're trying to trade the market, go ahead and turn off extended hours, especially if we're not in extended hours. Obviously, if I'm trading at 3 a.m., I can't see, right? So I need this. All right. So if I'm trading at 3 a.m., then turn on your extended hours. So for the case of Thursday, all right, so Thursday we fell. All right. Now, Thursday night, I was like, dang, we down to 570. Like, are we going to fall, or like, what's the business, right? So at market close, I came and looked at this because I was like, dang, it's under the VWAP. So I was like, is Tesla going to fall? Like, should I go buy? Because I was just going to go buy some stock and just like, there's less risk doing that. But, and I can make, $30 per share. right? So I was just going to buy a few shares and just try to hit a lick. But then I started noticing this movement. All right. So once the market opened at 4 a.m. Eastern, it's 3 a.m. my time. I trade off of Central Time. So when the market opened, that would have been a good buy for me. I should have bought at the end of the day. We opened up. Okay. So this was the first sign that let me know, well, folks are rejecting this. Okay. So we're riding. And this was what let me know, all right, I like this. Okay. I don't like to go green into the market because when you go green into the market, you got to go down. Okay. But I like this. I was like, oh, you want to come down first. Okay. That's even better because now the options just got cheaper. You know, I don't have to go buy, you know, an option at 590. I can get this 570. So I start coming in. I'm looking at the options, right? So obviously we're more around this 5. Got a chance to 580. So once the market opened up, notice that it actually dipped. Let's see if I can get this to load. Okay. So when the market opened up on Friday, it took a little dip right here. All right, y'all. When I saw this dip, this was all I needed to know right here because one, it dipped all the way to the price of the option. Okay, so the low for this particular interval was 577.20, and there is a 577.50 strike price. Okay, so that was like the immediate go sign for me. I was just like, I don't even care what happens at this point because big picture, where are you gonna go? Where are you going to go that I don't see already? Okay. If we're at the 200 EMA, well, cool. I'm comfortable here. I don't mind this journey, right? I like, you ain't got to be at the bottom of the Bollinger Bands for me right here. This historically is telling me you have gone too far. What are you going to do? Are you going to keep this price or fight it? Because essentially you can see that we fight around this, right? So the fact that we came back to it. So on Thursday, we closed below at 571, or 572 was the close, but we actually closed closer to the low. So we had a low of 571 and we closed to 572. So that's why I really wanted to make sure that I did my research before I jumped into this trade, because what had me a little weary was this. Okay, so we've been here before, and yeah, we had an update the next day, which is this too. But I was like, well, dang, G, you're still showing me that you can come low. So I was very prepared to exit this trade as soon as possible. Reason why I only took $300 in profit when actuality I could have made $1,500 off of I think that trade cost me about $400. I paid about, I think, 480 or something for it, and it ran up 300. And it happened so fast, y'all, that I was literally going in to put in my stop loss, and the option price had already hit like $7 and $8 premium. I was kind of confused because I usually don't pay that much for premiums. So I was a bit confused that I was putting in a stop loss for $8. I was like, what is going on right now? But yeah, I immediately came in. When I do the stop losses, like I say, I put in the bid. Okay, because if you have an option, so for the instance of Tesla, we had a low on starting that day at 577, right? So when the market actually opened up on Friday, we dipped to the price of that option, 577 right here. So which made this one, the next one, at the money, not in the money, but at the money. Okay, so that's like me buying this 600. Okay, if the time is right. Okay, so me buying that 580 option, man, that thing ran up so quick. And just look at it, right? If I would have held it even till close, or maybe even to here, I mean, all of this just went sideways. But even if I just wrote it here, right? I mean, like, but to me, I just did this. that's all I'm good for, y'all. I take profits, period. I don't care about what's to come. I don't get greedy because I know there's always another day and another trade. Okay, so why did I exit this? Because it was starting to reach these highs. Okay, and like I said, I don't get comfortable on that. So when I enter a trade, I do use lower intervals because I'm looking for the first sign of reversal. Okay, so the lower it gets, the more sporadic these readings get. Okay, so in this particular trade, probably as soon as I got this little red candle, I was out. Okay, just simply because of where we were hitting these highs, right? And then if you go to 15 minutes, all in one interval, there's really no red candle at all, right? So if you are more of like somebody that likes to hold, by all means do that. But you need to be using lower time intervals to see sort of these reversals if they are coming, right? So even with this, it's still kind of held as, I wouldn't use these lower intervals unless I'm actively trading, but still, even then, it shows you that like with this popping all the way down, like I said, this stochastic is key because it lets you know whether your entry is right on or not, right? Because you don't know whether you should enter right here. You don't know whether you should enter right here, but this stochastic said, we're done here, right? And then even the price was like, we're done here. But look at where it came to, the VWAP. Okay, this white line on my screen is the VWAP. Let me break down some of these. I can tell, super trend can stay. Yeah. But the EMAs, I only use the EMAs when we're looking at days. Like I said, that 200 was the sign for me. Then when I came in and I saw this 6-4, it had such a high open interest. Okay. So if you all, let me break this down again. Open interest is how many contracts are held at the open. Okay. That means out of all these people, right, out of all this volume, this many people were still holding contracts, right? And on the day till expiration is the number of days until it expires. This was at 1, right? So you got 1 day for all these people to sell. All these contracts either got to sell or lose money. Reason as to why this literally in 1 day just spent the day catapulting with no real, like no fight of coming down, right? This VWAP held it up, right? But the reason why those puts won the week prior to is because everybody for the entire week invested in puts, right? All the volume was in puts. Okay. So if you got this many people betting against you, right, your put call ratio is rising. Okay. Then I'm not comfortable here. That's why I said you got to be careful with higher put call ratios, because the higher the number goes, the more this type of thing happens. But when this gets to a point where you are too low in price in general, right, it doesn't matter how many puts are available. If people want to pay 570 for Tesla, those puts can't win. Okay. Now, why did I feel comfortable at 570? Because look, we've been fighting this area for quite some time. Like we had support here, we had support here, we got support down here. This was why I was saying I was a little scared that you could fall below this 200 EMA, but you still on the 200 EMA, right? So will Tesla fall from here? Yeah, I think so. Like just based on, even though it had a good day, that volume is weak. Okay, if we got an average of 34 million and you only put up 24, and the day before, let's see, 29, and it was falling, and then you only had 23 or 24 to come in the next day to try to pull you back. Okay, you're going down, right? So where's it going to go down? I'm gonna wait for it in this type of area, right? I don't want to jump what I can already see what happens, right? We've been here before. We've come here just like this bar. We did the same thing right here. Okay. And then on this particular day, we did the same thing right here. We jumped back above it. Okay. But even then, let's check the volume, right? So 44 million, 33 million, right? And the next day, 32. So if I can't see any strength in this volume here, oh, Tesla gonna go ahead and turn right on back around and head south. Okay. But I really wanted to break that play down to let you all know why I chose that Tesla trade for Friday. And Friday is really cool because on the day of expiration, contracts are literally expiring, worthless if they are not in the money. Okay, so all of this right here, let's say that Tesla holds this price for the rest of the week. Well, yeah, you may still be making 16, maybe 14, maybe 20. I wouldn't say 20 here. You would still probably be this or less, just because at that point the worth isn't there anymore, because I could just go buy Tesla for $600 if that's going to be the price, right? I don't have to go pay a premium to get $3 less. Okay, so your option does expire worthless, or you have to exercise it if it is in the money. Okay. So know that these things are eventually going to spiral worthless. If you're not in the money, you are out of the money, and these will all go from 1200. Let's say Tesla does what we assume and is going to turn back around. Let's say it has weak volume. All of these start to turn back down. As the week goes on, Tesla just gets lower and lower. Okay. I don't care if we end up at 610 and this is in the money, this will be zero come that Friday, June 11th. Okay. You could be making money right here, or let me make it so you can kind of understand what you're looking at. Let's say we end the week at $600. Okay. These people are making money. These people are zero. Okay. So that's why I say always be careful buying down here, because eventually you're going to be worthless if we don't get here. So now my theory in doing this and buying closer to in the money is because I want to guarantee my profits. Like if I already know that Tesla has fallen to 570 and I know that Tesla has the opportunity to jump back here, I don't want to risk Tesla going to 600 or 610 or whatever, because I can't guarantee that. But what I do know is we're done down here. Okay. And this is where I'm trying to make money. Okay. I'm trying to turn my 1,000 into 2 quick. Now, and I could have, if I would have held longer, I could have made $1,500, but I'm okay with 300, right? Because at the end of the day, my thing is once I'm in profit, I want to go ahead and set a stop loss. Okay. So if you're actually trading stocks, let's say for instance, you're like me and on Thursday night, you were like, yo, I want to come in and I want to buy some Tesla. Well, cool. Okay. New order. And you can say, hey, I want to do a limit order, but I also want to do a stop loss and a take profit, right? I know Tesla can run at 600. Okay. So let's say I want to buy, give me 10 shares of Tesla, and I want to buy 10 shares at 572. And I only want to be able to lose actually have to put that in. So if we bought it at 572 and you're buying 10 shares, it's only going to take $2. So 570 would be my stop loss here in order for me to only lose $29 on this particular trade. Okay. And then I want to sell it at 600 because I know we can get there. Right. And so that gives me a profit of 270. Okay. Now look at the investment that I would have to actually make that $270 when I literally only spent $400 on an option to make this same amount of profit. And I didn't even have to go all the way to 600, right? All my option had to do was pass 580. And that's what I did. Once I'm in the money, I'm cool with setting a stop loss. And with a stop loss, when you set it tight, it most likely will hit it. They have, I remember somebody was telling me about, I forgot what they call this particular bot that, hedge funds and like people shorting stocks, they will actually have this thing that will go looking for stop losses. Basically, because my stop loss is an active order. Okay. My order is on the market. And if some bot sees that, it will literally bring the price down, which happened here when it tries to bring the price down, knocking everybody out of whatever. Or either if you had a call, it'll scare you here. It'll be like, oh, you got a call? You feeling scared yet? Oh, you're going to sell? And then boom. Y'all ever had that happen where you're in a contract, sell it at a loss, and then right after that, it takes off? That's because of these types of things, because they're looking to take you out of the trade, right? That's money left on the table, because as you lose money, they're making money. So whenever I get knocked out of a trade, I'm not messed up about it, because whatever my stop loss was, I already set that in my mind that I was either really ready to take that particular loss, right? Or I was in a profit, and it's like a stop profit kind of thing. Like where, like when I bought this call here and it ran up, I immediately, once it started hitting I bought it at a $4 something premium. Once it hit $7, I'm already in here following it with a stop loss. Now, when you're doing stop losses and take profits or whatever on an option, most of your brokerages will not allow you to put a stop loss inside of this range. Why? Because it is an active spread. Okay. If you were to put your stop loss in here, it would actually take it just because it's in the ask and the bid spread. Okay. So when you're looking at this and you're coming in, and for instance, I bought the 580, right? Well, once I come in and sell, let's say right now this is active. All right. Tesla opened up, it ran up, boom, I'm in my 580. I'm literally going to put a stop loss at 2,700 or $27, right? Because number one, I cannot get within this spread without it closing, right? So if I were to put 2750 or something, number one, I don't think Webull will allow you to do that because technically it knows that your order is in this spread. Now, Robinhood will allow you to do this and immediately execute your trade. Right. So a lot of times in Robinhood, I remember when I was learning, I would put a stop loss and then it would like sell my trade. And I'm like, what is it? I've said, if you come here, sell. Right. But Robinhood doesn't stop you. It's just like, oh, you want 2750? Cool. So, it doesn't allow your option to keep moving. So notice the bid and the ask when you're putting in these stop losses, because if let's add the last price, because the last price will let me know. Oh, it's already here. Selected items. Okay. Well, where is it? Oh, it's right here. Last price. Okay. So for the 580, the last price was 27.67. So this is the money you're making right now. Okay. This is you. All right. So you're coming in, you're like, okay, I'm at 27.67. I want to set my stop loss at 27.50. If you're in Robinhood, it will immediately execute because the bid is 27.35. If you're in Webull, it will reject that order and it will say your stop price cannot be the same as the bid, or same as the asking price, or price of the asset, or something that it says along those lines. So what I'll do is, cool, 27 even. That's my new stop. And as it continues to run, I'll move that up. I'm following this bid though, right? So as my bid increases, I can move. So let's say my bid now turns into 28. Well, I'll move this up to 27.50 or 27.90 or 27.99, whatever I want. But know when you're doing these stop losses, there is a difference. There is a stop limit, okay, which triggers a stop price. So let's say you put in a stop limit, which I'll do on Robinhood to keep it from automatically executing my orders, because if you don't notify it of this, it will just execute the order, right? So the stop loss limit basically is saying that if this particular option falls, let's say I want to sell it at 27, right? I can put in a stop loss limit at 27.30. So if this price falls to 27.30, it will trigger my order at 27, but only if this falls to 27.30, right? So in other words, if you're just doing a stop limit, you will immediately just come in and say, hey, 27. If it falls here, just sell it, right? But here's the issue with the stop loss limits. Okay, if you use a stop loss limit order, let's say it does trigger at 27.30, your stop price. Okay, and it triggers your order for 27. If you put some weird number in there, like let's say you're like, oh, I want my stop price to be 27.30 and my limit price to sell to be 27.22. You're going to get skipped. You're going to get skipped because that means that somebody if you want 27.22, somebody has to be willing to buy 27.22. And the only way that would even happen is if by some chance, a snowball's chance in Hades, that somebody put in the price of 27.22, right? And not only that, but it would also have to assume that somebody's willing to pay the market price. Because when you're doing trades in options on Webull, I'm not sure it allows market orders to buy. I know Robinhood automatically does market orders. So like when you go into Robinhood, it's just going to be like, this is the price. If you swipe up, you're going to buy it at whatever is rolling at, right? But you can say, hey, for instance, when I came in that day, Okay, so when we opened up the market and this was technically 580, this was my options, right? You have the bid to buy at 1550, or you can buy it at what it's currently sitting at, 523. Now this is going to constantly move in between this range though, right? So this is the spread and this is the active price. So I can come in and Robinhood will actively give you this price. Okay. Now my strategy is a little different. I go for the bid. Now the bid is not always going to get you in the contract, but what the bid does allow me to do is automatically be ahead of anybody that paid this price. Right. So if somebody happens to have, which in a lot of cases happens, I wouldn't say all the time, but if I don't get in a trade, I'm not messed up about it. Okay. So if I put in this bid and it does not take my trade, so be it. I wait on the next one. I'm not chasing this stuff, because what happens is people will go chasing this 1530 and then it may run up to 1570 and then you trying to chase it and then boom, it drops back down to 1523. Now you're $50 behind or 30 or 40 or whatever, but here I am at 1550. I'm $8 ahead of everybody already. You see what I'm saying? Because these things have such volatility that they move. So number one rule in options, do not ever chase an option. If that joker is leaving you, don't go increasing your price, because what's going to happen is it'll actually come back down. Because what happens with options, by the time you know to go buy it, it's already assuming that demand. It's saying, well, dang, we got to increase the value because now the demand is here, right? So you have to be careful with these options. The safest strategy for me that I found is going for the bid, which is crazy, because with the bid, me paying the bid on that option, I took a screenshot when I bought that Tesla contract. I was already $25 up when I bought the contract, right? Within seconds, I was already up $25. Why? Because somebody probably had a stop loss or something in that allowed me to get this price and not have to pay this one or this one, right? Because these are dollars. Okay. So if you buy at 15.15 or you buy, this is $8 more than the bid. This is a whole $15 more than the bid. So if you go chasing this thing, you're already negative 15 right here. So as soon as you buy this contract, well, you're technically negative 7. Okay. When you buy the contract at the ask, that's why, you know, a lot of aggressive traders will say, buy the ask, sell the bid. I don't do that. Okay, I do sell the bid. I don't care where I'm at, how much money I'm at. I'm selling at this because I know people are willing to buy it. So if I have an option and I'm currently holding an option, I don't care about this price. I don't care about this price. I will sell at this price, right? So in the end, I'm willing to give up my 15 or my $7, right? I'm already up 3 or 1,500 had I held my contract for Friday, right? So like I said, aggressive traders use the phrase buy the ask, sell the bid. I do agree with selling the bid. However, if you buy the ask, you will be negative to start your contract, right? And let's say you didn't buy it at the right time. So even notice the spread here, right? This is a $25 spread, right? You can get yourself in $25, or you can pay this extra 25. Just know you will be negative 25 as soon as this contract opens up, right? So that's why I'm always going for the bid, because as soon as I bought this contract and a lot of other times, the option price will actually come down, or it won't come down, but somebody will have an order there. And then I can get that order, because if you're trying to sell at the bid and I'm willing to buy at the bid, nobody's stopping that order from happening. Okay. And what a lot of people miss out on is that they're not willing to put in the bid. They're just so aggressive. They're like, oh, this option is going to leave me and I need to buy it at the ask. Well, cool. Well, if you bought it at the ask and then this thing turns around sideways, not only did you start negative, but now you're really negative. Okay. Because worst case scenario that happens to me right here, I don't get in the trade. That's worst case scenario. If I'm buying the bid, that's worst case scenario, is that this thing leaves me. Okay. And the next scenario is if it really got worse to worse, right? Let's say I bought at the 200 EMA and Tesla did go backwards. Well, I know that this price has to come here first before I even lose money, right? So let's say Tesla opened up and it didn't go up. It actually went down. Well, cool. I bought at the bid anyway. So the price came to me before I was even losing money. But if I go chasing this option, now I've lost even more money when this thing starts to go down. Okay. So in all cases, I would rather the price come to me. I don't care if it's when I'm looking at the EMAs and trying to get it to come down, or I'm trying to get the RSI or the stochastics to come down. In every situation, I want this to come to my comfort zone. Okay. Don't ever feel like you need to chase anything. Okay. Because that's the number one way to go broke, especially with options. So, really, I just wanted to dissect that trade in particular and why I choose which strike price. But the keys here in terms of takeaway is really, if you're, let's say you can't afford to come in, because number one, I'm gonna tell y'all off the bat, I'm not paying this much. Okay, I don't even want y'all to think I'm this aggressive of a trader, but this is how like your biggest traders make money, is because they can come in and buy these expensive contracts. The only reason why I did buy in the money contract for Tesla in particular is because it was on an expiration date. So I could get it for far cheaper than usual. So just as an exercise, you know, you can look at these prices around here, right? Come Friday, you won't be making this kind of money, right? Because you'll be losing time on everything down here as far as a call. And then on these puts, you'll be losing money here. Right, so all of these will go worthless unless they start moving up here. So even on the SPY, it's actually interesting because it has multiple expirations, right? So there's an expiration for Monday, Wednesday, Friday, right? Monday, Wednesday, Friday. All right, so these things actually, I don't think that's Monday, Wednesday, Friday. I think it only adds them as the weeks come. So people trade the SPY a lot more frequently, so they have more expirations, because the QQQ doesn't even have that many expirations. It's just when there's a heavy amount of volume, well, the QQQ does. But there's certain ETFs like ARKK, which aren't indexes, where you don't get that many expirations, right? So the amount of expirations does tell you a lot about the movement, right? So if you only have monthlies, that's because we're not expecting you to move so much within a week. So there's no point in us trying to offer, options to trade during the week, because it'll almost be like just a desert land, right? I mean, I've seen some stocks. It used to be Digital Turbine, but Digital Turbine went from nothing to a lot. So a lot more people trade it now. But when Digital Turbines first started, it only had monthlies. And on these monthlies, they're slightly a lot lower volumes, as you can see, right? Now here we got a lot more open interest and volume. But for the most part, I mean, you're looking at some pretty low numbers, right? And so, but when you're looking at the SPY, we're going to have a lot more expiration dates and a lot more volume coming in to trade these, right? 77,000, 44,000, right? Because we need to have options for these people. If that many people want to trade, I don't just want them on Fridays, because that would affect the market, right? So if I could come in and predict a Tesla like that, I don't need the indexes to be this predictable. Okay, because if I come in and I look at the index and I see this type of information, well, the market's going to fall, or the market's going to go up, right? And it can't have that type of influence. So that's why they break it up in the days. So the more expiration dates you have, the increased amount of volume there is in trading. So if you ever go trading some stock and you're like, man, I'm gonna trade the options. If you open that joker up and it's only got monthlies, probably not a good idea, because that means that the volatility and volume is not there in order for it to be worth it. Now, that does not mean you cannot trade them, but it does mean that your spreads will be larger, right? So, see, they increased the spreads on apps now, Digital Turbine. Digital Turbine used to be my perfect example of like things to be careful for, because of like low volume, but the spreads were much larger. They had spreads of $5. Right? So it would be like 65 and 70. Let's look out a little further. It might do it further. There we go. So if you're looking for a longer contract, you don't get as many options. Okay. It's either got to jump $5 or you're going to be losing some money. Look at these folks. They losing money, right? And they got a call and the price went up. Okay. And they losing. That's why I say you have to be very careful what option you pick. Okay. And you can't go trading every option and everything, because this was one of the key ones that I lost on and I learned my lesson. And I was like, all right, I ain't trading every option. I'm just going to trade what I'm comfortable with, because even with these longer expirations, they move slower. So in the case of this, even though you're in the money at 65, well, you still haven't broke to the next one that give this one strength, right? And not only that, you're moving slow. You move sideways. I told you, any day you go sideways, you lose money. Okay. I don't care if it's green, red, whatever it is. If you go sideways, you lose money in options, because the whole value in options comes from the ability to get an advantage on a price, right? So the idea is that, oh man, when apps was 50, I'm not sure if I want to buy 100 shares here, because I'm not sure if it'll fall, so I can come buy the 50 strike price just in case. So when it does run up, well, dang, I only spent so much money to buy this premium, and I'm sure it was lower than 1900. So let's say hypothetically it was around here, right? You bought this option at 760, and now it's worth what price did I say? 50. So $1,800, right? So you've got yourself a quick 1,000 in profit, a little more than 1,000 in profit, and you can take the money and run, right? But look at how long it took for it to do that. This was in May. We are now in June. So a little over a month, or a little under a month it took for it to do that run, and it took you a month to make 1,000. Now that's not bad, because you bought time. But to me, I can make that money in a lot shorter of an increment with more strike prices and quicker movements. But even here, let's look around the strike price. Look, they even lost money, because why? We went sideways. Okay. So if you look at what happened in the day, we started up, we went on a high of 69 and actually closed lower, right? So anybody that was going to make money, you should have took it when it hit that high. And even there, I've still got this red line showing this previous high here. But generally speaking, you want to take profits when you get your options, okay? Just in general. So before we jump to some questions, I'm going to pop up the AMC for Kim. So let's drop around here. So obviously all these people with the calls are losing money because it's been dropping. But let's say hypothetically, well, we would mainly be looking at puts here. Okay. So for me personally, I had a $50 put, and which I probably paid like $200 or $300 because it was at 70 when I was looking at this. So I probably was going to go for this 50. Actually, I did go for the 50. I think I paid probably 2 or 3 something for it and made a couple hundred within just minutes. Right now, if I would have held that contract, obviously I could have made some more money. But I don't go in it for the long run. I'm really trying to take the money while I can. Because even like I said, the longer you hold these things, you have to expect to lose some money at some point, just simply based on the fact that these expire worthless. And the only reason why they gain value is because there is some sort of incentive for you having the option to be able to get this particular strike price because you missed an opportunity to buy lower. Right. But as the price settles around these prices, these lose intrinsic value. These lose overall value because the value is not there anymore. Right. If I want to just come buy the stock, I can do that. Right. I don't have to come in and pay you some premium to buy at $47. Heck, I can just go buy the thing at 47. Right. So that's why also upon expiration, these are actively losing money. So when you get out of the money, yes, they are cheaper. And I'm not saying don't do that. I'm just saying you have to be careful when trading them, because take a look at something like Apple. It's super cheap to buy in the money, out of the money, wherever you want to buy, right? Because Apple's heavily traded. Okay, so the demand is there. So let's say you bought, Apple's not going to run at 130 anytime soon, but let's say you assume that in this week, this is the week for Apple to do that. Right now, you can buy this contract for as low as $27. Okay. Now, if Apple were to reach 130, you have now turned that 27 into possibly 200 or $1.40 or $142. Right. So you've made 100 or a little more. Right. Only if Apple gets there. Now, if Apple stutter steps and then Thursday it trips up, you coming back down here. You coming back to down here, and it's even going to be worse then. Right. So let's say Apple even gets to 129 and 130 is just sitting here hoping to make it over. If if this 130 strike price keeps sitting right here, it's just going to lose money. All these folks right here, they're losing money, but at a slower rate. Okay. Because even look at their percentage gains decreasing as it goes up, right? And these are people that are in the money, right? Now, why are they losing cash as well or not gaining as much? Because nobody's interested in buying a strike price for 116, right? So the demand for your option is going down. Like nobody cares to buy shares of Apple at 116. Cool, I'll just buy it at where it is if I assume it's going to go up from there. I'm not looking to go buy a premium to buy it at an old price. I'll just work with what I got. So just know, number one, don't ever just think you're just about to go buy one of these in the monies and then you're good. I always want to buy at the money, right? Because this is going to increase so much more in value moving from here to there, especially on the day of expiration. The lotto is like heavy because on the day of expiration, let's say it's June 11th, right? This is not going to be $1.42, right? It might be more like 30 or 40 cents just because it's like, yo, if you're not here, you're technically worthless, right? But if I can get Apple to move to 126, as soon as it does this thing might go from 30 cents to 80 cents, right? It just depends on what the values are looking like right here in terms of demand. But that's how I made that lotto on Friday, because Tesla was as low as $400 premium, but that's not something you're going to see. You're not going to see $400 premiums on Tesla unless it's like right at expiration or you got to go out of the money. Right. So the only way I could have gotten the price that I wanted for Tesla was to go as far as 630. But that's not something I want to do, because that would have to be with the assumption that I would think that Tesla would run that far. Right. But if you're going to go for these types of out of the money contracts, make sure that you're watching it. Right. Like if you feel that, looking at Tesla, if you feel that, hey, we get a resistance here at 645, or even just a resistance at 600, right? Just because 600 is sort of this like hype, sort of like the psychological resistance. It's like, okay, we were down here, but we ran to 600. Cool, that's as far as you're gonna go, right? Even on this day, the high was 661 cents, right? And it closed at 599. That shows you how much of a resistance there was right there. But that's how far I'm willing to ride this trade. I'm not expecting it for it to go to 630. I'll take my $600 run, because even then, let's say you only could afford this $400 strike price. This 630, technically speaking, we know that it moved about five strike prices, because it started at 577 for the day. So 1, 2, 3, 4, 5, 6, 7, 8 strike prices, right? So technically this $400 strike price, you would have bought it at 1, 2, 3, 4, 5, 6, 7. Wow, I only have 40 of them showing, but let's say hypothetically, still, you can do those types of things, Kim. You can come in, you can buy this contract for $2, right? And then you can run it up to $4, right? But you need to understand that that is your last chance. That's all you got right here, because Tesla ain't going to 630, not anytime soon, not based on this volume and not based on what I'm seeing here. Because not saying that it won't run up. I don't think it's got the juice. I think all of what happened Friday was just puts being released. Those puts, all these people that were betting against it in 1 week, they had to go ahead and take this victory, because it was going to be bouncing back. So the only reason why this happened is because of the leverage that Tesla had against it on Friday. So all of these people had to sell. Now, all of these people, they could exercise their contract. They could sell for a profit. They could also wait for these people to sell just to make more money, right? All these people were such an advantage. They were not scared when the market opened. So when Tesla had that little dip when it opened up, those people were not afraid, because what are you going to do? What are you going to do? Drive it lower than we went yesterday? What are you going to do? Right? So if I already know that all of y'all making puts, everybody that had a put, okay, was already making money. These people went to sleep this night on Thursday, just like, Lord, I hope it's down when we wake up, right? Because otherwise I lost the money I could have made here, because everybody with a put, One thing I noticed is that they did not sell. I guess these people assumed that Tesla was going to drop to 550 or something. And they assumed that this was going to end up worse, right? But as the market opened, they were like, oh God, oh God, oh God. So everybody would have I have to put myself in their emotional pants, okay? Everybody was sick watching this bar happen. They were like, oh God, Lord, no. And then they were like, dang, it's not going down. And then they were like, this was like their, okay, as soon as the market opens, I'm going to sell. This was like the key for them. They were like, man, okay, all right, the market's going down. Okay, sell my put, sell my put, sell my put. Oh, calls, bam, shot it at. Because all those puts that were selling right here, they had to let go. And for the rest of the day, you see it didn't get dragged down, not even one bit, right? Just straight up, I mean, it took a little break here, and this was people selling their calls thinking that this was it, because essentially it was. We made it to $600, and this had a high of 598. Okay, so me personally, this is probably as far as I'm gonna go, but I'm gonna tell you right now, I let go within a minute. I made $300 in like 1 or 2 minutes, like no more than that, because this is the only bar I needed, right? So when I come in, make this trade, it's based off of, number one, the indicators, but also looking at the put call ratio is so important. Okay. So based on just me breaking down options, strike prices, bid, ask, put call ratios, everything, are there any questions?
Well, yeah, I got a little lost with the bid call. I still get a little confused with that.
Bid and ask?
Well, the bid and the ask, but if I'm buying a call, I gotta buy the bid, not the ask. If I'm buying a call, well, there's a couple of things, but it's so much to cover. It was the bid and the ask, and also, let's say, you know how you went to Tesla, right, and you saw all those in the money, right? Yeah. So why are people holding on to those if they're in the money? I mean, I get that if they wait till Friday, but you know how like Friday expires, and then I had a contract and it expired worthless because I didn't make any money off it. What if Friday comes and I don't know, I can't get to, I'm in the money, like I made money and but it's Friday, so this contract's not going to be here. Do they automatically put that money in my account?
Oh, you're saying that if you do not sell, you're in the money.
Yes.
What happens?
Yeah.
If you have not clicked the box, do not exercise, it will exercise your option. That has never happened to me, but I think it happened to my dad one time where he held a contract that was in the money, and it actually like it'll debit your account. Basically, your contract, like let's say our profits from the options are actually a discount for our buying shares. So it will exchange your profits, and then it will deduct your account for the remaining balance of buying 100 shares, okay, at that particular strike price. So let's say for me, if I would have not closed my 580 call contract, I would have bought 100 shares if I had the money, because I'm gonna tell you right now, I don't have $580,000. Okay, not even close. So on this particular day, if I have a 580 strike price, these are multiplied by 100 because we are buying the option of 100 shares. This gives them an opportunity to own 100 shares. So if you do not sell your contract or close your contract, I want to make sure it will give you a discount. It will use your profits as a discount to purchase 100 shares at your strike price, right? So I would have gotten a $2,007 $7 or let's say a $2,700 discount off of a $580,000 purchase.
Okay, they do really janky stuff because they should just give you your money. All of it.
So if you're using Robinhood, a lot of times when your contract goes worthless, say you got 10 contracts or 20 contracts and they're a penny, Robinhood won't even let you get your $20 or your $10 or whatever.
No, I use T Ameritrade, and I see but it's not like I'm gonna like money just sit there and be like, oh,
yeah,
it's
because
Friday, and unless emergency came up. But I was just wondering about that.
and even when it gets to that, like I've had contracts. I remember Tilray one time, my contracts had gone worthless. And I was honestly like, do I want my $20 or like, should I just leave it? And I was just like, you know what, I'll leave it. It was the day that Tilray did all that little running up to like the 20s, then the 60s, and the 70s. And I just fortunately still didn't sell my worthless contracts. And I woke up with $400 just off of me not selling for 20. You know what I mean? Because my thing was, well, dang, to me, y'all, when I cut my losses, I'm okay with like, an $18 or $20. Like I'm like, for me, that's better than nothing. Okay. Because I realized how these compound losses add up. Because there was a time in November where I just kept getting knocked out by stop losses because I already had bad entries. Okay. So when you're not looking for the right entries based on either your put call ratios or your indicators, well, you're already in a bad position. So any stop loss you have is definitely going to get hit. Okay. And so what was happening?
I feel like also though, hun, a stop loss is, I mean, they're good and bad, but if you're like, okay, I'm not to the point where I don't trade like, okay, I'm going to do these trades and walk away, because until, and probably won't be another year until I just step away, because I feel like I know so much because I watch the market and I understand it more because I sit from it from open to close. Yeah. So I don't really need to set a stop loss because I immediately will hit and stop myself to where, I mean, and I've done it plenty of times where it's like, okay, I don't want to lose anything. So I'll see it go to like balance even, and I'm out. So I know I don't necessarily need to do stop losses because I can stop them myself because I'm watching everything and I don't have a lot of contracts. I just get greedy and think, oh no, it'll go. It has nothing to do with me losing money because I let myself do it because I in my stupid mind, I think that I'm smarter, and no, it's gonna, for some strange reason, it never does. But right now for today, like I literally like the devil comes over and takes over. Like, I don't know what it is, but I mean, you know what I mean? Like I become a stupid zombie. Like, girl,
but I would recommend stop losses because,
well, I don't really know how to do them correctly. Like on Ameritrade, like it's like I'll go to like, it's a stop, a limit, and I don't, it's like, and by the time you do all that, like, I don't know.
Well, the worst thing that could happen, I remember one time I was in the same boat as you, Kim, and I was like, no, I'm watching this stuff. And I remember vividly because I had actually made quite a bit of money leading up to this particular trade. And it really built a lot of confidence in me, and as well as the capital for me to take this type of risk. But I went and bought like $600 worth of Mara contracts. And I was certain that Mara was going to go up. And I was just like, cool, I got this $600 in there. And, I don't have to watch this. I'm just going to go take a nap. I woke up from my nap, $530 down. I had $70 worth left after that $600. So with a stop loss, I could have at least woke up and only lost $30. Right? Or maybe $100. But like the thing about the stop loss is you have to use it with a better entry. Okay. So let's say with Tesla. All right. I'm going to enter this trade confidently. Okay. Because we are at the 200 EMA. However, I cannot make this stock to go up. Right. So with that being said, I would like to minimize my risk. Okay. If I know this is feasible, I don't want to have to come watch Tesla or go look at the market all day and then like be like, oh, well, Tesla's down at this point. Now I need to react. A stop loss allows me to be proactive rather than reactive, right? Because what I don't want to do is be in a situation where I haven't already calculated my stop loss or even set anything. And then I come in here and it's moving and I'm not sure, should I buy? Should I go ahead and sell it? Should I cut my losses? Because what I've learned with not using stop losses is I have the ability to lose a lot more money because I cannot force the market to go up. right? I
Yeah.
cannot force any of these things to go up. They are going to go up and down, up and down. Look at all this red and green. And these are days, right? So one day you're doing good, next day you're not. One day you're doing good, next day you're not. Same, right? So what I do want to do is be able to take advantage of this day, right? Like if we're in the wind and then I know that I can open up here and close down here, well, I'm going to go ahead. If I'm opening up here, right? If we opened high and we had a high of the day, my stop loss allows me to now walk away. And what am I walking away with? Profits, not these losses, right?
You're
Because
right.
y'all, I don't think y'all understand. I will take a $12 profit if it takes me out of a stop, right? Because my thing is, what I've realized, I've seen this happen, y'all. I've been trading for officially a year now. Okay, so I've been able to look over my account and see when I'm losing, when I'm winning, right? So I know when to trade strong. I knew June was going to come into being a stronger month once we got rid of all this stuff. That's why I was looking for these types of opportunities. Now, how did I find the Tesla? Is because I use my screener. And there's not too many stocks left on the screener that I use. How do I get this thing to go away? But when I opened up my screener, let's see, where is it? FinViz, and I need to change this these settings because I have it on up, and then I have the profitable. All these are different, right? So in terms of oversold options, I think Tesla might have been, well, it's above it right now. I don't think it's oversold anymore. Maybe I had to take it off or oversold to kind of find it. But even Apple is right now above its 200 EMA. But I like to find them below. And I think for that particular day, Tesla was below, right? So Tesla, yeah, it was below. And that's how I found it. So it was below, and it was technically in this 40 range, right? So that's how I was able to find that for Thursday. Because I said, hey, I want oversold at 40, right? Because that lets me know that you're kind of falling down, and the price, oh, get this close. Oh. Okay, so I put it on charts as well. But when you're looking at this, you can say below or above. You can move this as you please to find different things. And if you don't see what you like, then adjust it, right? If you're not looking for something that's completely oversold, then change it to any, right? Because at the end of the day, if you're below the 200, you don't have to be oversold. You're already on the graph oversold, right? Like I don't need, and here's Tesla right here, right? So Tesla didn't necessarily come up and oversold, but I know with your price below the SMA 200, you're already oversold on the chart, okay? I don't need you to be oversold on RSI. Now, RSI does let me know when my position is better to enter. But for this particular trade, I look for stocks that I'm familiar with. I don't go trade, like, I'm not just going to come in here and be like, oh, EDU looks good, I'm going to go trade EDU. I don't know EDU. I haven't traded EDU. I'm not using the screener to go look for new stocks. Now, you can use it for that, but when you do that, make sure you need to study what's going on. One thing I do know is when Tesla comes down here, it bounced up. So that's what I was willing to trade when I saw Tesla come up here. And that's how I found that trade. So that was just kind of to speak on the point of always watching the market. You don't even got to do that, right? I used to be, like you said, it becomes addictive. Okay, y'all, I would sleep, dream, like think everything trading, right? Like that, my life was on hold. I mean, I would not eat from the time it hit. And I mean, even when I was really beginning and I turned my Webull account from like 100 to 1,000, I was aggressively trading at 3 a.m. Right? I would come in, buy stuff at 3 a.m. Like sundial was 25 cents. I would buy it and then I would let it run up to like close to $1, then sell and then set another limit price. Because you can do that as well. Like you want to be able to walk away from the market. Cool. Well, I know that Tesla can come to 560, right? Tesla can come to 560 and bounce back, right? So we got support 560, 560, all this support at 560, right? Cool. Well, if I'm comfortable right here, cool, put me in an order right here. I want to buy 10 shares of Tesla for 560. And then I want to stop this at 5%. So you can either do 5%, which that's $280 loss you're setting yourself up for, or you could say that, well, I know that Tesla can fall as low as 540. Okay, so if you decide to break this 560 level of support, let's say I let it go to 557, right? All right, cool. I'm cool with losing $30. Bet. Well, I know that from this 560 mark, well, we can run up to 600, right? And then I can say, all right, cool. Well, when it gets up to 600, take my profits. Okay. And this allows you to really just be able to walk away from the trade. All right. So when you're coming in and you're looking at this and you want to have more of a almost riskless trade, you need stop losses, because if you don't, and then Tesla breaks this support and runs all the way back to 540, well, you just lost $200 when you could have just lost 30. Because hell, I know looking at this, if you can't hold this line right here, you come in here. There's no doubt about it, because we've been here before. All right. So I know that if you cannot hold this, you can't hold this, you can't hold this, you can't hold this, and you can't hold this, you're gonna come here. That's why I have this line here just waiting. I'm waiting for wait when I get an alert that Tesla has now fallen below any of these things, right? I'm ready. I'm ready. I don't have to watch the market all day. I can go sit on the beach, and then when it says, hey, Tesla just fell below 555, cool. Okay, well, let me go ahead and buy some, right? Or let me see what these indicators are looking like, right? Because if I see something like this, I'm coming in. I'm coming in all gas, no brakes, right? Because I know where it can go, and I'm comfortable riding it to 600, right? Or I can ride it to 630. You know, whatever you feel comfortable with, but you have to first be looking for these ranges, right? You have to first know what's going on, because the reason why I felt comfortable paying that much even for an option, because I'm gonna tell you right now, $400 is still a lot for me to be paying for an option. I really don't trade that aggressive. But I saw the opportunity, right? And no lie, Kim, as soon as I was going in to put my stop loss, I was about to put in a stop loss for like 460. Like, just don't, I'm down to lose $20, and I'll give you $20 room. But as soon as I was willing to go put in that stop loss, I was forced to put in a stop loss at $8, and I'm okay with that. And then it knocked me out as soon as I put it in. I put it in, and it ran up a little bit to like 830, and then it like shot back down, took my order, then took off again. I'm cool with that. I walked away with $300, and I literally, all I had to do was spend 2 minutes working, like literally just coming in and saying, cool, I'm comfortable here at this line. I know that we can fall here. And so based on what this MACD was doing, as well as these, it looked like it was pointing down, but with this momentum passing it, it was like, oof, that means that this thing is literally leaving the price either willing to pull it back up, or it's going to pull it back down with it, right? But the fact that this was so far down and it didn't pull the price with it, that gave me the sign that I needed to know from reading this put call ratio. The number one thing I saw here was this: 267,000 people had to let go of contracts. If you're holding a put, you aren't comfortable. Okay. Now you're comfortable all in this right here. So you're comfortable over these last few days. Yeah, you comfortable. Oh yeah, Tesla's falling. Oh man, I'm really making some. Oh man, I just hit the lotto. Right? Now, if you don't take your profits with your puts, you're gonna wake up sick. Okay. And that's exactly what I knew was gonna happen to these people, because I knew at this price, I knew that there was gonna be enough people to just think this was a good time to buy Tesla. Now, me personally, I didn't buy shares because I still knew that Tesla could fall. So what I did want to do was come buy all these shares when the market closed right here, and then I wake up down here, because that's feasible. Okay. This was not in the stars. I can't guarantee that this was going to happen. Okay. So the reason why I didn't buy shares here is because I assumed that, well, we still have room to fall. So know that the decisions that I make are based on my risk tolerance, as well as what I feel is right. Right. If I know that, yeah, 570 is a decent price for anybody that just is like, Tesla used to be 900 and now it's 570. Yeah. All those people, they can get got right here. They can go ahead and buy, but I'm not doing that. Right. I'm not trying to wake up and then I'm down $30 per share because I just wasn't patient enough to wait on what I know is available here. Right. So with that being said, when I woke up and saw that we were doing good, well, that let me know that we could actually do even better coming into the market, and I could be ready to buy a call. Because this bar right here, like I said, I don't ever want to be going green into the pre-market. When people are up 20% or 15% or even 5% pre-market, you got to understand that all of those people that may be having calls, or maybe they have Robinhood accounts and they can't sell until the market opens, right? Because we bull people, we can take advantage of this. We can be trading in and out of this all day, right? But Robinhood, they have to hope for the best here. And they're going to be looking, if it's going green, let's say this did this, well, it would have been a lot different bar right here, right? Even look at this. This is a perfect example. Started up, came in down. Like, I don't care who you are. If you come up in the pre-market, you're going down as soon as the market opens. I don't care who you are. And I don't care who said buy and how far you think it's going to go, because even if it were to go up, let's say this part right here, maybe you were looking for this, you still had to go down before that, right? So I don't look for green bars before pre-market. That is not healthy for me. Okay, that means that too many people bought, and all these people, they want to take their money too, right? So they sold, and then once they saw it was getting weak, everybody sold. Okay, so I don't ever want to be up. I want to be down before the day, and I also want to be down just before the market. Okay, because that's going to give me the opportunity to be catapulted up. Because if I'm up, they're going to sell. If I'm down, people are looking to buy. Right, because they're like, ooh, here's my second chance, right? I didn't buy here last night, but it came right back to me right here. So I always want to be looking for an opportunity to be catapulted up, okay? And that being from your indicators, or just being from reading these put call ratios, because this was the like I said, this gave me, I was so happy when I saw this, because like looking at the most active, right? When you go look at most active, you kind of get a big picture, right? You can look at what you feel comfortable trading from here. I know what I'm not going to be looking at from here, right? Like say Amazon. Amazon, if you want to buy a put on Amazon, it's a great time to do that. Because I'm going to be honest with you, I don't see a lot of Amazon up this high, which means there are extremely large amount of people that are willing to bet against Amazon. So let's just take a look at Amazon. Amazon's options are extremely expensive, so I don't trade them. However, I know I will be buying this whenever it gets done falling. But looking at the chart, right, this is an hour, let's go to a day. I do have a range here, and I know the 200 EMA is right here, right? So what people are betting on is that this is going to fall. You could not hold these EMAs, so now you have to head to this EMA, right? So you notice that this is the 100 EMA. If it was fighting, which has been trying to, and then it really tried to push its way back up, but then once it opened and closed back, this is what kind of sent it back down on this spiral, right? So now, if you want to dissect it even further, you can come in and you can say, okay, well, I want to know, where is this put leverage? If more people are buying puts, well, what week is it? Right? Because is it this week? Is it next week? So in particular, it's for this week coming up, right? So this week coming up, there are a lot of people holding contracts against Amazon. So what we can see from this point of view in general, look at all this heavy put call ratio. This is literally saying that people are betting against Amazon right now. Why? Because it's heading to the 200 EMA and they can make some quick cash. Right, because we know where we know where the indicators are letting us know, but we know physically where the price can go. Okay, so if we up here, it's no problem for us to come here. It's no problem for Amazon to drop $70 even in a day, but give it a week, right? And it'll be right back here, right? And then once it comes here, what can it do? I don't know. I'm gonna find out when it gets here, because I'm gonna need to see this MACD. If it's as low as this, then I'm all gas, no brakes, because I'm trying to get this right here. All right. So always keep in mind to use screeners, use these bar chart, because you don't want to just watch the market. The market is going to do this stuff like AMC and GameStop and all different kinds of things. I mean, look at even coin, right? That thing just been going down since it opened, right? So it's like you can come in and say, oh, this is a good price. Everybody said 250, and here we are below, right? So I'm always patient. I'm always patient. Even then, you would want to come and look at if you're going to trade options. These are the most active options, right? These are the options that's going to really make you some money. You can go for all this other stuff, but it's telling you that it's not as much volume in these as much as it is these, right? So in the terms of if you're going to be trading options, or even if you're not trading options, you still need to watch this information, right? So for things like Microvision, AMC, GameStop as well, I do know that some brokerages are going to stop allowing margin buys and stuff on those types of stocks. So you won't be able to use margin. I think it'll only be like cash positions, and then maybe they'll start doing some option weird stuff as well. So these stocks will be affected come Monday. The game stocks, your Microvision, your AMCs, BlackBerry, all this stuff won't be able to hold its weight this heavy. But we can see that now AMC, that put call ratio did drop simply based on we brought that price from 70 to and 60 down to 47. And plus it did hit 30, which probably brought so many more people coming in trying to buy calls, right? So like I said, please use these tools. They're crucial. I do not trade without them. I do not hit the market without doing my research. If I have not done this charting, if I have not done and looked at bar chart or looked at a screener to see if it's in my position that I like trading, I will not trade. I don't care how good it sounds. And I don't care how many people are expecting it to go where. I feel more comfortable trading when I have all the knowledge that I need, because I do not need to be making any emotional decisions when trading. Okay. I don't want to be scared and I don't want to be greedy. Okay. What I want the most is to be confident. And I was confident based on what I saw from Tesla, which was probably it wasn't my only trade of the week, but one of the most confident trades I was able to make just simply based on what I saw and what I know. Okay. So please use these tools and don't feel like you have to trade every day, right? Because this is not a get rich quick scheme. Okay. This market is here every day, and these opportunities are going to be here every day, and they're not going to be with the same stock. They're not going to be with the same sector because there's rotations, right? So you can't trade Apple every day. You can't trade Tesla every day. But I know when I need to be waiting on the right moments to trade those particular stocks, right? So be patient is key. Patience is key. There's this quote that floats around all the time from Warren Buffett that says that the stock market is just a battle between the impatient and the patient. And I used to be impatient. I'd be like, oh, I want to get in this trade, put me in stop loss, and then boom, it knocks me out, right? But I wasn't patient enough for the right entry. Okay, because we don't have the right entry, we're already at a loss, because what's going to happen is we're going to go negative, and that's going to increase the fear. Like, should I stay in this? Should I get in this? Well, if you can't answer those questions, it's because probably you didn't have the right entry to start with, right? You didn't even map that out in the first place. So I know there was a lot going on in the beginning of the week going up, and I missed out on that, but I'm okay with that because I didn't have enough time to do my research. Right. So if I'm not doing the research I need and I'm not charting the things that I need to chart, you will not see me trading. So I was a little silent for the middle of the week because I wanted that whole like run to be over. So everybody come in, make your money, do your thing. Yeah. Because at some point that's got to stop. Right. The buck stops somewhere. Right. So if I come in and buy Shopify at $1,000, I'm not going to expect for it to do this $1,500 again. But what I will do, I'll take my profit with this 245. That's where you want to go, 250. Cool. I'll take that. Right. I can't expect for these things to continue to run. Once I feel like it's hit a hurdle, you can go ahead and take some profits. Right. But the only way you're going to really truly be able to find these points is through indicators and these price actions. Right. I know that the price gets rejected at this point. Right. So anytime I enter here, even off of a 200 EMA, which happened both times, right? This thing fell right on the 200 EMA, came off, fell to the 200 EMA, came off, right? So one, even if you're going to enter a position right here, you can be patient if it comes down here, but be ready for what you think could be as far as it fell. Because right here, it did fall this low to 1,000. Right here, it only went as far as 1,025, almost, but not yet, right? So you always want to be prepared for these types of things. But generally speaking, if you can find out how it interacts with price action or the indicators, that gives you a better entry than trying to enter here and then be like, well, I hope it goes back up. Well, you came in a little too soon, right? Number one, your MACD was in the middle, your RSI is in the middle too, and your stochastic was in the middle, right? So that means that you could go either way, and that's not a good idea, okay? Because yeah, this could have gone up, but it also could go down. I don't like those odds, right? But when I'm in a position where my stochastic is down, my RSI hits a point where I'm like, okay, it's like right here, the price was a little higher, but then we went even lower in price, but still the RSI didn't budge. Okay, that's showing some strength, right? And then we hit the 200 EMA. Okay, I'm feeling comfortable, right? My stochastic is down. My MACD is starting to level. My RSI is literally saying that even though we're not at the same price, we're at the same strength, right? So this is giving me everything I need to know right here to give me this run. Now, why would you stop right here? You got to look at price history. You got to look at what happened in the past. Where were things rejected? And that's as far as I can assume I can go for now. So when you're trading, make sure you're looking for all these points because they're crucial for our success, right? We do this to make money and not lose it. So anytime you're in a profit taking situation, let's say you let it run up to here, go ahead and set your stop loss, right? Because even if it knocked you out here and then you're like, man, I might be able to take this run. Well, no, that actually didn't happen, right? But in an option, you technically would have been losing money right here anyway, because it will see the value dying down, right? So anytime you're in profits, don't be afraid to use a stop loss. Anytime you're not in profits, please don't be afraid to lose stop loss. I've seen so many people in these one-on-ones that have allowed positions to just go in the mud. And now you have to use more leverage to get out of them. And in options, you're actually adding more risk, right? Like at least in shares, we can assume that eventually it'll go back up. Well, in options, you can't make that assumption because technically they're going to expire worthless. So if you average down in an option and it's still not a good option, you just added more money to lose, right? But at least in shares, if you do that, there's an opportunity to eventually go up, but time is not working in your favor with options. Okay, so you got to learn when to let go of options because they don't hold their value. And that's honestly what I love about trading them, is that I'm not married to them. I'm not committed to holding them for a long time to see profits, right? And I don't have to put as much leverage in them to see those profits. So when I'm trading options, I can get instant gratification and I can go ahead and take my money and enjoy my day, right? But I'm not looking for some lottery ticket because that's how you lose money in options. And I've been there. I had to get over that. It's a phase that you have to go through to learn more patience because I was addicted almost. I mean, I wouldn't even say almost. I definitely was. I would wake up on time. I don't even have time. I wouldn't eat breakfast. It would just be straight run into options and I was losing more money. It's like you could have a big win, but then you end up doing 3 or 4 more bad trades after that great win and you just gave up 75% of your profits, right? But like if I can literally go in, there was a couple of trades I had in the beginning of the week that were maybe just like 30 or 50 or $60. And then I waited patiently for that $300 trade from Tesla. Well, bang, that puts me at sort of a goal, if you will, for the entire week. Like my goal is to make $100 trading. I don't have to do it in one day. I don't even have to do it in 1 week, right? If I can do the average over a month or average over a week, that's fine because I made 3 days worth of profits for me and a goal in 2 minutes, okay? Which means that I can take the rest of the week off, right? I don't have to aggressively trade because that's how you compound these gains. Because I think I was watching this one documentary on Netflix and how they were talking about like how day traders are technically gamblers. And it is simply true because if you're trading every day, you're going to lose, Okay, you're not going to win every trade. There's no such thing as somebody out here winning every trade and they're day trading every day, right? So with that being said, the more chances you increase of playing this game, right, the more chances you have to lose. But if I only strategically come in when I know my chances of winning are better and I only trade then my chances of compounding these gains over time becomes greater. I make more money now and trade even less, right? Like I've never met somebody that trades more than me that makes more money than me. I mean, like, unless they just have millions already and they don't mind taking the risk, right? But anybody that trades every day, I already know that they're losing a lot of money as well. Like, so definitely be patient with these trades. You don't have to trade every day. I make more money now and I trade a lot less because I wait. I wait. And a lot of times too, like when I used to see things, you'd be like, oh, maybe I should. Well, I know that, this isn't a good example, but let's say you looked at this and you're like, well, I know that it's got support at 1,184 and I think it'll come bounce off this line. And then you try to jump this line. And then here we are, we're going to come to the line number one. So now you're already losing money. And then on top of that, you're going to lose even more money if it doesn't hold that line. Okay. So that's why I don't trade every day, because not every day that you're going to catch the right trade. Because even how I was showing you all when you're looking at the market, right? And this is really like the perfect example because you can come in and trade every day with these stocks, right? But there's going to be so many days that you're going to lose, right? Because these have nothing to do with each other. Okay, this is a streaming, this is electric vehicles, and this is a Kathy Woods ETF. But they all have the same chart. Okay, they all got the same chart. Okay, so when you're looking at this, you have to understand that you can't, as much as you shouldn't trade Tesla every day, you can't trade the rest of the market every day because every day is not going to look good. And if I can see that these three stocks in itself have nothing in common, but they have the same trajectory, that means that I shouldn't be trading every day. Okay, because here you are trading on these days buying calls. I'm trying to buy calls up in here, right? I think it's more like right there. Yeah. So here you are all in these days right here trying to buy calls and stuff because you think we hitting these levels of support and stuff, but ain't nothing coming back, right? None of these came back, right? But if I just wait to trade on these days, right, I can catch these bounces, right? If you just wait on these. Because trying to trade every day, it'll get you cut short because I had to realize that, dang, this has nothing to do with this, and this has nothing to do with this, and this ain't got nothing to do with other than holding these two. Well, that means I shouldn't be, if I don't like buying puts, I shouldn't be trading on these days. And these are days that I need to be sitting out, waiting for these types of opportunities, right? Because they're going to come. It's going to come for Roku, it's going to come for Tesla, and it's going to come for ARKK, right? But if you try to trade any day before that, right, here you are thinking, oh, we're going to catch this run up. Oh, we're going to catch this. Nope. Up, drop, right? And you got another drop right here. So that's why I say, even looking at the similarities and things that are so different lets you know that every day is not the day to trade, unless you want to go both ways, right? If you feel you're aggressive enough to do calls and puts, by all means, put it, call, put, call, put, call, right? But I don't that's too much emotions. I really just try to focus on calls, unless it's something like AMC that you don't even have to have emotions for that. I'm gonna buy a put on that all day because AMC is not staying at $70 or $60, period. Okay, so when I go buy a put on AMC, know that it's because it has no chance of staying there, has no business up there. The air is way too thin for it there, and I know it's going to suffocate. So I got no problem spending money on those types of trades. And it doesn't take too much strategy on those types of trades. You just got to wait for the right moment. Because what I'm glad I didn't do was when it was like $30 and $40 and I thought that was the max, I'm glad I didn't buy a put there because those puts became almost worthless when that thing started to take off to 70. So anytime you're looking to buy a put, make sure you wait for a red day. Okay. Don't go trying to, beat it, right? Because even here, people may have thought it was going to fall. It did for a second, then shot back up, right? So even up here, right, you might think, oh, this is the time to do it. But the next day it opened even higher, right? It opened up here and fell down here. So you may have thought this was the peak. Then you try to come by a put, and the next day you losing money as it runs up here. Now, if you got patience, you can make money in that day, but even after that, ran up again, right? So I want to see signs of losing volume, and I want to see that you're completely maxed out up here. I want to see a couple red days before I just jump in. Even with Tesla, it's been 3 days up here in this $900 range before it just completely collapsed right here, right? So this day it went -3, this day -2, and this day in particular -5%, right? But you got to be patient. You can't just jump the gun on puts. Same thing with calls, right? I mean, even with you coming in right about here, you may think to buy a call, then the next day it drops as low as this, right? So always be prepared with your stop losses so that you don't lose money, because if you walk away and you don't have a stop loss, one thing that is for sure with options, it will take every penny. That is a fact. Okay, those things will go worthless, and your $600 will be nothing. And unlike stocks, right? You can go invest $600 in stocks. In order for you to lose your $600, the stock would have to go to zero, right? Not with options. Your option could go to zero, and the stock could not move. You know, so definitely stop losses are so important with options, because this is not stocks. This is not something you can walk away from and just be like, oh, it's going to be good. Nah, because like 1 penny or $1 is all it takes to completely deplete an options contract, depending on which way it moves. Or you can make money, right? But I want to be there for that. So, man, I just kind of rambled on that. But any questions in general? Any questions? None, zero. Everybody getting it? Cool. Well, I will save this call. I'm gonna also, I swear I say this every week, but I've been busy with like websites. I also do a lot of stuff for the cheat code, running their social media. So any questions you all have in general as well, you can shoot me. I wouldn't contact me through the cheat code because I do not run their messages. I only run like the comments, but you still have access to my page. You can send me a message there, and I'll try to get to it. But so yeah, with this call, really just wanted to chop out using the bar chart as well as the stock screeners to find the right positions. But then once you find the right positions, make sure your put call ratio is in your favor. Whether you trade options or not, you need to be looking at this chart, okay? Because anybody holding Tesla would have known that Tesla wasn't going to fall completely on Friday, and that was an opportunity to buy or at least take advantage of that little run that it had from 570 to 600, right? Just based on the put call ratio. So cool. I'm gonna drop off this, but as always, y'all, it's a pleasure. It is a pleasure. I really appreciate all you all tuning in. But I will save this and send this to you all so you can kind of review it and look over it as well. But please use me up. Any questions you have, drop me a line. I'm here to help, and I really appreciate it.
Thank you.
Yeah, thank y'all. Well, y'all enjoy your week. Any questions you got during the week as well, drop me a line. I got y'all. Because I want to make sure you all are charting right and everybody's understanding this. And most importantly, I want you all to be winning, okay? Because this is no good unless you all are walking away and at least being able to learn how to find better positions. So anything I can do better as well, let me know, because please use me up, okay? But y'all enjoy the rest of your weekend and have an amazing, beautiful, blessed week. I hope y'all make some money. Don't get too greedy out there. Let's take some profits, all right?
Yeah, bye.
Okay, y'all be good.
Thank you so much, Ray. Bye-bye.
My pleasure. Gracias.
Bye.